If you're thinking about getting an Index Universal Life Policy or IUL, one of the questions you might have is about the fees. What kind of fees will you be responsible for? Can the insurance company change them down the road? And how do these fees measure up against traditional investment options like 401ks or IRA? Hi, I'm Gilbert, and in today's video, we are going to break down the fees associated with one of the top IUL products. We'll cover which costs are locked in and which ones might fluctuate. Plus, I will show you how these fees compare to those in traditional investment vehicles over the long haul. To give you a clear picture, I'm going to use an example of a 35-year-old male with best health rating who plans to contribute $20,000 a year for 20 years, and I'll assume a growth rate of 6% before fees. I love to be conservative when showing numbers, so I'm going to use 6% in this example. This policy is designed to maximize cash value growth by keeping the death benefit as low as possible, just enough to allow us to contribute $20,000 a year. This is the ideal setup if your goal is cash value growth rather than a high death benefit. Let's look at the fees. The premium charge is a fee the insurance company deducts from any premium payments you make into the policy. A lot of people might not be aware, but insurance company pay what we call a premium tax to the state they do business in for any premium they receive. So part of the premium charge is used to meet that requirement. Premium charge will usually be between 5 to 10%. For this product, it's 9% for the first year, then it drops to 5% from year 2 and beyond. The good news is that there is no premium charge if you don't make any premium payments into your policy. And for this specific product, the cost is guaranteed, so you won't see any unexpected changes. You can think of the policy fee as an administrative fee. For this product, it's a fixed cost, $7.50 a month, so that's $90 a year, which is guaranteed to stay the same throughout the policy's duration. Then we have per unit charge, also called per face fee, per thousand charge, depending on the insurance company, but it's the same thing. This covers the agent's commission as well as any cost the insurance company incurred to put the policy in force. It depends heavily on the amount of base insurance as well as the age and health rating. For this product, this fee applies for the first 15 years and is guaranteed during that period. After the 15th year, it disappears. The cost of insurance is what you pay for the life insurance coverage itself, and this is where things get a little bit more variable. Because IUL is based on annual renewable term insurance, the cost increases as you age. In the early years, when the risk of death is lower, this expense is relatively stable. But around age 70, it starts going up as the risk of death increases. The fees we've discussed so far are included in every IUL policy. However, there are other fees which may or may not apply depending on how your policy is set up. Most IUL products include standard riders like chronic illness, terminal illness, or even critical illness rider, often with no extra fees. You can add other riders to your policy, like a child rider or term insurance rider. I added a supplemental term insurance rider in this example. That's why we have the rider charges. This rider allows us to blend term insurance, which reduces the expenses in the product because it doesn't pay commission to an agent for the amount of insurance we blend in. So the total cost of insurance will be the sum of the cost of insurance and the rider charges in this example. Without blending term insurance, the per unit charge is $1,348 and the cost of insurance is $416 in the first year. But when we blend term insurance, the per unit charge drops to $479 and the total cost of insurance for the first year is $209. Blending term insurance saves you a lot in fees. Unfortunately, most agents don't do this because it reduces the commission. By blending the term insurance, the commission reduces from $6,908 to $1,794. Some IUL products have what we call an account value charge, which is a percent of the accumulation value as part of the fees in the product. It's very similar to how investment management fees work. In an IUL, it will last between 20 to 30 years. Now, this is part of the fees, it's part of the product, it's not optional. Others have what we call an asset charge, which provides bonuses for a fee. This type is optional. For example, in this product, for a 1% fee, you could add a 40% multiplier, which means if the index returns 10%, you would get a 40% bonus, making it a total credit of 14%. I didn't include this rider, so we don't incur any costs. Surrender charges are not actual fees that come out of your policy every month. They only come into effect if you cancel your policy within the surrender period. So for example, this product has a 12-year surrender period, which means if you were to cancel the policy before the end of year 12, you will incur a surrender charge. The surrender charge is the difference between the accumulation value and the cash value. At year 13, both of these numbers become equal, and at that point, there is no surrender charge. One important cost that is not shown here but is worth knowing about is the loan fees. In the next video, I will cover how loans work in an IUL. When the video is ready, it's going to be in the description below or somewhere up here, so stay tuned. One thing I really love about this IUL product is that almost all the fees are guaranteed except for the cost of insurance. Mind you, no other IUL product guarantees the cost of insurance because IUL is based on annual renewable term insurance. This means the insurance company can adjust the cost based on factors like changing mortality rates. The expenses in an IUL are front-loaded, meaning they are higher in the early years and lower later on. Let's look at the fees as a percentage of the accumulation value. These are the same numbers we've been looking at. I just move it over to Excel to make it a little bit more easy. $20,000 going into the policy for 20 years. First year total charges $2,577, which is 13.8% of the accumulation value. From year 2 to 7, the fees as a percentage of the accumulation value drops drastically to 1.1%. This is what we mean when we say the cost is front-loaded. The fees start off high in the early years because the insurance company has to pay out commissions and also recoup some of the other costs they incurred to put the policy in force. But the fees drop off in later years. After year 7, the fees as a ratio of the accumulation value is very low. In fact, much lower than the fees in many traditional investment accounts like 401ks or IRA. In the 401k, the fees get bigger and bigger as the account value increases, which is very different from how an IUL works. Now, let us assume this same account value is sitting in a managed account. I am not trying to compare an IUL to an investment account, but what I'm saying is if we have this same value in a managed account, how much will it cost us? How much will we pay in fees? At 1%, it starts off very low, 186 compared to what? 2,577 in an IUL. But you can see that it doesn't take long for the 1% fee to start building up quickly. Yes, in the early years, the fees might seem very excessive, but remember, these policies are designed to be held for the long term. We're talking about 20, 30, 40 years or even more. Plus, you benefit from the safety and growth potential of the policy, along with access to the death benefit for chronic and terminal illness. Let me know which other topics you would like me to cover in the comments below. Also, feel free to add any questions you have. I will respond to each one personally. Don't forget to like, subscribe, and hit the notification bell so you never miss a video. I'm Gilbert, and I will see you in the next one. Bye.